Libby Toudouze, one MLP you like over at Cushing is EQT Midstream Partners. Now it's only down around 7.5% over the past year, but it's outperforming a lot of the other MLPs out there, a lot of the other pipeline players. Why is that?
So there has been a little differentiation in the MLP space. EQT moves natural gas. So crude oil being down doesn't really impact natural gas. They're predominantly located up here in the Marcellus Utica region. They have 80+% of their business is fee-based, and they're what we call a demand pull pipeline. That means they are going to the downstream users. That part of the business is actually doing very well, and we're seeing volume increases because prices are so cheap. The upstream the companies that are struggling and the midstream companies that are dealing with them, that's where we've got volume issues.
All right, so let's talk about Sunoco Logistics. Now this thing is down around 35% in the past year. And a lot of people got burned by MLPs because they were told, well, it's just a toll taker. So they just move the natural gas or the oil through the pipelines. But that didn't seem to be the case because people got burned.
So there's been a huge disconnect between the operating businesses and the stock prices. And energy equities, including all the midstream companies, have been lumped in, are captive to how crude has been trading. Sunoco Logistics actually has several businesses. They're crude and refined products, but they also have a big natural gas liquids business, again, up here on the coast, and they're in a fantastic position to be the dominant player to begin to export natural gas liquids to Europe. So they continue to grow their cash flows, their distribution continues to grow, yet the stock price has taken a big hit.
Well, you mentioned Europe. Let's go to Europe now with VTTI. This is a London-based MLP. It's down over 20% in the past year. It pays a nice 6.3% yield. So talk about VTTI, why you like this one.
So Vitol is a storage company. So they're energy infrastructure in the storage space. And they have a parent, the Vitol Group, which is one of the biggest independent energy traders in the world. So when you have excess supply of crude oil, what do you need? You need storage. So they're in a perfect position. Again, they grew their distribution last year 15%. They expect to be able to grow it the next 2 years. You don't see that reflected in the stock price, but the operating business is actually doing very well.
And then finally, like TARGA Resources, this is Houston-based. It's a Houston-based player, and it's really gotten hammered over the past year. It's down over 70%. Why do you think this is the bottom?
Now, for TARGA is a business. They move natural gas liquids. They're in the Permian Basin and on the Gulf Coast. They've got a premier footprint, but they do have some commodity exposure because of the natural gas liquids. And TARGA is probably been hit somewhat justified. However, they continue to grow the business. They have access to the capital markets. They've just rolled up their MLP into their GP. That will save them some cash, allow them to delever a little bit, and we believe continue to have a good business as we go forward.
All right, well, thanks a lot, Libby.
Thank you, Greg.
And thank you for watching The Street.